Yeah, I'm losing my
Today we are
edge.
talking about whether or not markets slow in the summer. This is something that's been, I think, intriguing traders ever since trading became a formal line of business with institutions in the 70s, 80s, and 90s. And then when those markets were brought to retail traders, there's this idea historically that everybody goes on vacation in the summer. And of course, summertime is more of a time for vacation. If you've got children there, they're out of school, you can more leeway to go on vacation. It's easier, more flexible for a lot of companies to do so in the summer. A lot of companies, retail shops and restaurants in places in Europe and the United States just essentially closed down for summer in a lot of cases. But I wanted to see today if markets slow a little bit. And what we've historically done with a segment like this is go over the last couple of decades and see, okay, what has the stock market done on the average month? And then what does it do on the average month in summer, being June, July, and August? And I want to take a look at small exchange products and see, this being their first summer, how the transition has been from July to August. And July, while it's already a summer month, I think late July and August are really considered essentially the dog days of summer. So let's see what has been cooking here for the small exchange's first summer. Looking at realized volatility, you can see that August's expected range is very different than July's. Now, notice that I said different and not smaller, because you can see in the small stock 75, you've got a range here that's set to be in August that is almost half of what it was July. That is definitely slower, smaller volatility. But you look at the small dollar product /SFX, due for a little bit more volatile of an August than July, not by much. And then you look at precious metals, and if you've heard anything about gold or silver, July of 2020 here is probably the most volatile month that those markets have seen in the last couple of decades. And so you're seeing almost a doubling of that range. And this is kind of what we're used to seeing, especially when you go from asset class to asset class, is no month or no time period tends to be more volatile than the last. It's just every month and every time of year has its own type of trading. And now these are three markets that have zero seasonality. Historically, I've looked at all three of these markets over with decades of data, and none of them see the kind of seasonality that's seen in natural gas or agriculture markets, which is to say those markets move differently in the summer than they do in the winter time. But in the summer, just on the whole, you don't necessarily see different trading with something like stocks, and it's this thing that we've checked out with the numbers. As what would have been even more interesting is if I showed you small stock 75 movement in maybe June or May of this year, slower than it would have been in July. So it's not like a summer versus winter thing. It's just a different scenario for different asset classes across different times in the calendar. And right now you're seeing a cyclical lull in volatility in the stock market relative to what was very volatile in the springtime. And now in the summer, you're seeing a pickup in precious metals when metals were actually interestingly slow in the spring when the stock market was moving all over the place. And, the numbers back this up, but even anecdotally, if people were on vacation, say, there were less participants in the market, maybe you could make a case for slightly lower volumes in some of these summer months. Lower volume usually goes hand in hand with larger movement and volatility as a function of reduced liquidity. The news cycles don't stop. Monthly data releases don't stop moving around markets here. When you talk about non-farm payrolls, something that's going to happen on this Friday, it's not like everybody in the government took the whole August off and non-farm payrolls isn't going out. Those things don't slow. It just might be a little bit of a dip in volume, but you can make a case that a dip in volume would actually exacerbate movement, cause more volatile moves with fewer participants in the market. But I want to show kind of how volatility and how markets become slow or become fast, because you can see here, and this is a little bit of what I was talking about. June, actually a bit of a volatile month here, which caused July to have a wide range. And just to back up a little bit, we're looking at these ranges that are a function of realized volatility, in the same way that a lot of people who are experienced in options trading would look at ranges as a function of implied volatility. Are they the same thing? No, but they're very close together in that implied volatility and realized volatility will both spike, and you'll see larger expected ranges as a function of both of them after a lot of movement in the market. And so what you're seeing here in stocks is, I mean, the most volatile part of the year obviously was March. So you're seeing some of the widest ranges right on the heels of that movement. But what you saw after that was a little bit of a slow period. And then in June, a lot of movement, which caused a big expected range for the month of July. It's both volatilities are very backward looking in that sense, where they tend to see a spike after a lot of movement. And that's when a lot of short option traders, they look for those spikes in volatility to sell those options into, but not really what we're talking about here today. What you see here is the range for August dropped down to 50% of what it was in July as a function of a very inside movement. Now, this is merely to say that, yes, the stock market has slowed here in the dog days of summer, but usually you'll see these ranges widen and contract as a function of what just happened. So I wouldn't necessarily say, okay, it's gone from small stock 75 expecting a $6.50 range to a $3.50 range. And so small stock 75 will not move here in August. It'll move even less than July. No, that's usually when you see this reduction is when you tend to see a surprise and a larger move. So definitely not, this is what is expected for August, but definitely not an indication of what is going to happen. Because you see here, you had a smaller potential move in the US dollar, and this US dollar surprised everyone with a big sell off here in July. And then you look at SPRE, which is kind of the most extreme version of this as we go through the asset classes, you know, something that was expected to move a lot in the stock market and then didn't move at all. And then something that was expected to move a little bit and then moved outside of it. Wow, a little bit of a surprise. And then something that wasn't really a big expectation for metals at all here at the start of July ended up moving 3 times its expected move. And there's a little bit of a trend here that I hope that people are catching on to, which is, you know, now we've got low volatility here in the small stock 75. We've got medium volatility in SFX, and we've got high volatility in metals. And so this means that you have to get a little bit more creative with a low volatility market. In the medium volatility market here in the US dollar, I think there's more room to trade both sides and be dynamic with, oh, I can add some of this here, I can add some of that here. In SPRE here, the precious metals, the highest volatility market, there's, you know, a lot of stuff to potentially do. And thus, I think you can be really patient with entries and exits, as we've seen in the last week or so of trading. Now, how does that factor into direction? I mean, you can make the case, if you're looking at extremes, that the US dollar is very cheap relative to the last year of trading. If you like extremes and you're looking at precious metals, you could make a case for precious metals being very expensive relative to the last all of trading in metals going back to when futures launched in the 70s. These are the most expensive prices that you're seeing in gold right now. But the trend that I wanted to speak to a little bit in terms of volatility, and something that option traders are definitely already kind of in tune with, is short option trades tend to be best when you've just seen a surprise. And then also on the flip side, with the small stock 75 having seen no surprises in July and seeing its range cut down in half, the last thing I would want to do is sell a bunch of options in a stock market. And now the flip side would be, okay, well, I should buy everything that's cheap and I should sell everything that's expensive. We've shown before that that's not necessarily the best or easiest trade in options just because you need volatility to increase and you need that market to really, like we keep saying, surprise you in one way or the other. So I wouldn't necessarily advocate for that, but this is more of how would I append option trades onto a small stocks or a small dollar or a small precious metals? I would get my direction in here, and you'll see that through how standard these markets are and how small they are, it's very efficient and simple to get that core direction on in any of these markets. To as small as, I mean, all three of these markets move typically about $100 per day. And so you can kind of size up, oh, I want to be long stocks or I want to be short stocks. I can size up my core positions in these three very efficient smaller markets, and then also append option trades according to the volatility environment in other markets like NASDAQ and S&Ps. And soon enough, you'll have calls and puts to, buy SM75 and sell a call against, or buy SFX, sell a call, or sell SPRE and sell a put against that. That'll be coming very, very soon. But now this is how I would append option trades onto positions in these markets. It's in the same way that you would look at the price here in small precious metals. If you would say to yourself, oh, wow, this is really huge rise. This is expensive. I maybe want to get some short. I've got some short opinions on this market. You would also take that same train of thought and say, okay, well, the range here as a function of volatility in metals has just doubled, and options prices have similarly doubled with that volatility. So that makes for expensive option prices. And then on the flip side of that, I don't want to necessarily be selling a reduced range in option prices on the stock market. So getting both of those gears turning, price extremes and your opinion on a price, and then option premium opinions, that'll get you to this end goal of a trade that at your core, you're getting your opinions on in the small stocks or the small dollar, and then also appending it with a little bit of an option trade, and not necessarily have to, but something that Pete and I have been looking at is this long small stock 75 and then short S&Ps or short NASDAQ against it. And to set that up, all I would simply do is buy the small stock 75 and then maybe buy a put spread in / NQ or QQQ, the NASDAQ ETF, against it, given the fact that calls just not historically expensive in that NASDAQ right now, with the market at its highs and premium not necessarily as high as it's been in the past, and especially true for the S&P 500. We definitely look at long put spreads against a long position in the small stock 75, and then you move over to SPRE, and if you wanted to be short that market, but then you wanted to sell some premium against it, something that I've really liked looking into is short SPRE and then short puts, which would be a short option trade here in a market like SLV or / SI. And I think with SLV per one contract in SPRE here, we're looking at about 30 to 50 deltas in that SLV market, and that's not going to fully offset the short deltas in SPRE, but it's a nice covered position in there. So you could do a naked option in SLV or a short put spread, but you could also do the same thing in gold. Gold is historically more expensive than silver, so I would tend to like to get my short put exposure in silver. And then if you wanted to buy small precious metals, but then sell some calls against it, I would look at GLD or / GC. But yeah, it's just a matter of creating that core opinion that can be used to trade against. And that's something that I guess broadly speaking would be called hedging, and not the most attractive way to trade to a lot of people. But I think something that is very useful is having an anchor to hedge trades against, and definitely profitable strategies in that, especially here in the summer where markets, if you're looking at equities, markets are slowing. But if you're looking at currencies like the small dollar product, or gold and silver, which are present in that small precious metals product, those markets are the fastest they've been all year.